Have you seen two people in Delhi streets fighting? None of them will actually hit the other person, but it would seem to you as if one guy is just about to hospitalize the other. In fact, there's that immortalized dialogue, "Tu janta nahi mera baap kaun hai." You have no idea who my father is. So each one tries to show how well connected or dangerous he is, how much damage he can cause, which is precisely what the US Central Bank, the Federal Reserve or the Fed, did in its latest policy meeting in June. It paused raising interest rates, and this was the first time, by the way, since March 2022, but it had its fists up. It was like, try me, bro. Just try me. I will not only hike in the next meeting, but will also hike in the meeting after that. You think over 5% interest rate is high? Wait till I go to 5.75%.
You want to play games? Okay. I'll play with you. Come on. Okay. You want to play rough? Okay. Uno. Say hello to my little friend!
See, that's why you should never watch movies with economists. But wait, first things first. What's this fight about? Well, inflation. See, inflation has been rising in the US since 2021, especially during the post-pandemic recovery. In fact, at one point, the Fed infamously called it temporary. Now, to put it in Lord of the Rings terms, central banks are like Frodo, and inflation is a bit like the ring. You need to destroy it before it destroys you. Because much of the trust in the financial system and the economy ultimately rests on a central bank's credibility to keep inflation under control. So, come 2022, inflation is still rising and the Fed panics and start raising interest rates aggressively. So we go from close to 0% to over 5% within a year or so. The conventional idea is that if I raise interest rates, the economy starts slowing, people start getting laid off, that reduces demand for things, and then hopefully bring down inflation. Well, at least the part of inflation that is being driven by this demand. Now, the Fed's problem is that none of this is quite playing out. US growth still remains pretty strong. Yes, they had a banking sector crisis earlier in the year, but things have pretty much stabilized now. Yes, there are cracks emerging in the labor market as far as the latest data is concerned, but on a whole, people are still getting employed. And worst of all for the Fed, inflation is still high. Its target is 2%. It's currently at around 4.2%. So there's a Bengali song that goes, "Ami kon pothe je choli, kon kotha je boli," which translates to, what do I do now? What do I say now? The Fed is having the same dilemma that I have whenever I try to cook something in a pressure cooker. How many CTs or whistles, or in Fed's case, interest rate hikes are needed to soften the damn thing? So, in June, the Fed took a break from hiking interest rates, but then did what those Delhi street fighters do. Tried to communicate to the market that the Fed is flashing red. It said that it now expects higher growth in 2023 than it previously thought. It has raised its inflation forecast, and it's basically saying that, look, we are nowhere near our comfort zone. The way we see things now, most of us in the Fed still think that we need to further increase interest rates by 0.5%, which, by the way, 0.5% in central banking terms is not a joke. Two implications for us in India. One, if the Fed is raising rates at a time when the RBI has stopped, the difference between India's high and the US's low interest rates narrow. And for regular investors, the US dollar still remains one of the safest assets. So if your safe asset is paying you higher interest rate, you will tend to gravitate more towards it. So our currency comes under pressure. Again, granted, that's not always the case. There's a lot of factors influencing currency, but the point remains that emerging market central banks have no option but to carefully monitor what the Fed does next. Second, the higher the Fed takes interest rates, remember, the higher are the chances of things spiraling out of control. See, it's a bit like having to apply brakes on a bus that's going too fast. The bus in this case being growth. If brakes work, then you could apply them lightly and the bus comes to a gentle halt. This is what economists describe as a soft landing. Or you might apply it a bit harder and the bus jerks to a stop, maybe causes a few bumps. But what if the brakes are still not working? So then you yank it down with all your force and you also pull up the handbrakes. The chances are that the bus will hit a tree skid right off the cliff and into a deeper recession than you bargained for. And because it's the US, it will drag the rest of the world with it, which is what we economists like to call a hard landing. What landing will actually happen is anybody's billion-dollar guess. For more such insights, like, share, and subscribe to The Bond Economist.